Hey, what's going on, everyone? Alex Pagano here, Mortgage with Pagano. And have you ever been wondering if you would do well on a mortgage trivia or quiz? Well, we're going to take one. We're going to go over the questions, see if the answers are even right. And I'm a professional mortgage loan originator, home loan expert, so I should know the answer to all these questions. We will see if any of them, one, slump me, or two, if they're just not right or there's something, there needs to be more info on the question. So let's hop right into it. We're gonna go straight into this mortgage quiz. All right, so we developed a mortgage quiz to enable you to become a more informed borrower and save time and money on your loan. Okay, the mortgage process can be complicated and overwhelming, so take our quiz to test your knowledge of important mortgage topics. I can agree to that. The process can be complicated and overwhelming, so that's why it's important too to have a good loan officer who's gonna make it easy for you, because the process, yes, is already hard enough. Get someone who knows what they're talking about and can relay the information to you accurately and of ease. Okay, so it's gonna go over credit score, mortgage affordability, total monthly housing expense, mortgage program selection, mortgage length, and comparing. Okay, so let's go straight into it and see how we do. Okay, first question. What is the minimum credit score most lenders require to receive their best interest rate on your mortgage? All right, so this one, let's see, we have our options. You can do a little pen. 450 is a no. You can't even buy a house with a 450. You can buy a house with a 450, but you have to buy cash. You're not gonna get a mortgage with a 450. 500, so yes, you can get a mortgage with that, but you're not gonna get the best interest rate. You're gonna do more aggressive down payment, it's gonna be FHA, and you're probably not gonna get the best rate. So that leaves us with 800 and 680. So as a mortgage loan originator, I run pricing and I see what interest rates are all of the time. And if you have a 680, you're gonna get a decent interest rate. But if you have an 800, you're gonna get the best rate, okay? So I'm gonna go ahead and I'm gonna go with the 800. And let's see if that's correct. So 680 was the correct answer. Lenders typically require the borrower to have a minimum 680 to receive the best interest rate, although yes, you can certainly qualify with a lower. So, all right, this is a good point. If you have an 800 credit score, there's different tiers of credit scores. So if you have an 800 versus 680, if you shop this with 20 lenders, the person with an 800 credit score, I would say probably 20 out of 20 times for a conventional mortgage are going to get a better interest rate. Now, the only other situation might be a VA loan, where VA loan does have federal regulations. So if you're over a certain threshold, maybe 680 or in the sixes, you're gonna have the same interest rate between that and the top 800 credit score. So for conventional loan though, I would say that this answer is probably not the most accurate. All right, so question number 2, how much of your monthly gross income should you spend on your monthly mortgage payment and other debt expenses? So how much you should spend. That's an interesting way to word because it's an opinion. When it comes to a mortgage loan and guidelines, it is not opinionated, it is very factual. So there's a set guideline and then you run it through an automated underwriting system. It's like a big algorithm. It goes through all the pages of that underwriting guidelines and it says yes or no. And it gives you the terms of why it's approved and how it can be approved. So how much of your month should you spend on your month? Okay, so 65% is no. That's way too high. 22%, that would be great. 22% is super low. The lower this number, the better, because that means your income is just so much higher than your debts. So 22 would be great. 58. So this one doesn't really give you an exact loan program. Like VA, you can go up to, and these numbers here, guys, are the same as your debt to income ratio. So when you hear your lender saying debt to income ratio, this is what they're referring to. It's all of your current debts plus your new monthly mortgage payment. So if your new monthly mortgage payment is $2,000 and then you have $4,000 in debt, you're gonna have to qualify with your income and $6,000 of debt. So, I mean, I know the answer just because, so it's gonna be 45%. That's just what I'm thinking, because that's like kind of the standard max that they say. You could go a little higher. Conventional, I've seen approvals at 50%. FHA can go higher as well. I've seen approvals at 55%. And the highest I've seen is VA. VA can sometimes go over 60%. So just for the purpose of this, and there are a lot of nuances in the mortgage industry and loan approvals. So when they're saying should, that's probably just a general, like, you shouldn't exceed 45. So let's go 45, yeah. They typically spend a maximum 45% of their gross monthly payment, blah, blah, blah. Okay. Question number 3. Which of these cost items are considered part of the total monthly housing expense? So you have your mortgage payment, which I'm assuming is just your principal and interest. You have your property tax, which is typically these are escrowed into your payment. They don't have to be escrowed into your payment, but you're going to receive better terms. And typically you can only have that option if you're putting 20% down. So if you're putting 20% down or more, you can waive your escrows, which means you can pay your taxes, your insurance separately. Now, if you did do that, you wouldn't have PMI or MIP. So these are all, could be part of your housing expense. You have your HOA, you have your PMI, your mortgage insurance premium for FHA loans, property tax, homeowner. So these could all be considered part of your housing expense. So we're gonna say all, yeah. Include your monthly plus property tax, yeah. All right, moving on here. Your interest rate and monthly mortgage payment will not change with what mortgage program. So adjustable rate mortgage, adjustable, that means it's gonna change. It's an adjustable. Fixed, that means it's not gonna change. So right there, that's an indicator that your mortgage loan or the product that you have, the rate will not change because it's fixed. Interest only as well. Interest only, they're not typically fixed and they're shorter terms. So we're gonna go with fixed rate here, boom. Yep. Monthly mortgage payment interest for fixed stays consistent over the life of the mortgage, yes, making it the lowest risk type of mortgage. Yeah. All right, mortgage length. What length of mortgage offers both the lowest total interest expense and highest monthly mortgage payment? All right, so you have 10-year, 30-year, 15-year, 20-year. So the biggest things you want to see here are offers the lowest total interest expense. When you're looking at loan programs and terms, the lowest total is the lowest number of years. So obviously 30 is the highest, 20 is the second highest, 15. And you would think 16. 15. You would think that because that is more common than you hear of a 20 or a 10-year, which I'm pretty sure that's the answer because it's the lowest. So you do have a 10-year and 20-year option for mortgages, but they're a lot less common and talked about than a 30-year or a 15-year. So we're gonna go with 10-year. Yep. The shorter the mortgage term, the higher the monthly mortgage payment, but the lower the interest and total or interest rate and total interest expense over the life of the mortgage. Yeah. So 10-year, it's not as common as a 15-year or 30-year, but it is still an option. There are still 10-year fixed mortgages. Lender comparison. All right, this is the last question, so let's see. What document is a lender required to provide that allows a borrower to compare multiple mortgage proposals? Okay. So you have the loan estimate, verbal summary, and closing disclosure. So the answer here, this one's obvious. And when you're shopping for a mortgage, there's really one document that's official, typically they're from the loan originator's system. So system as in the computer of which they're calculating all your information, all the percentages, and that's gonna be the loan estimate. The verbal summary, this is, I'm thinking maybe something that's said over the phone or is put in an email, which I would not recommend. I would recommend actually getting something on an actual statement, whether it's a loan estimate. A loan estimate typically is when you're in process with that lender and they've already disclosed the loan and you're proceeding. But I would typically try to get something a little more official when you're shopping. So if you want to shop with if you currently have a mortgage loan proposal and you want to shop that, give me an email. I'll definitely help you out and make sure you're getting the best terms possible. So, but this is definitely gonna be a loan estimate, yeah. Lenders must provide a loan estimate that outlines the key mortgage terms, including interest rate, costs within 3 days. Yes, there's a 3-day rule. So, and that 3 days starts when your actual information is fully entered in the system, and that's typically with an address. So once the lender puts an address into the computer, that really opens the 3-day window. So I hope you guys like this video. If you want me to do any more mortgage quizzes or answer any of your guys' questions, let me know. I will make more videos, and stay tuned for the next one, and I'm excited to do more stuff. All right, guys, take